So now we'll move on to the main steps in ZBB. So the first step is activities are identified by managers. Managers are then forced to consider different ways of performing the activities. So when a HOD, departmental HOD wants to create a budget and give it to the principal, he usually gives in ZBB a two kind of a two structured budget. Okay, one is a basic budget that is definitely needed, and the other one is a budget that can be postponed later. Okay, so it can be like a basic and luxury, like that we can say. So these activities are then described in what is called a decision package. Okay, so each of this, the new computer 2 lakhs, basic is 2 lakhs. So this is called as a decision package, where within that package, okay, the departmental manager should explain, or departmental HOD should explain the analyzes the cost of the activity, what's the cost of the activity, why it should be done, so that's purpose, identifies the alternative models of achieving the same purpose. So we could do it in a basic form, and also we could try to postpone it, like that also they have to tell. Assess the consequence of not performing the activity at all. Okay, so what would happen if we never perform by new computers, what would be its impact, or performing it at different levels. So in a form like what is the basic and what is the luxury or postponable activity. So as regards this last point, the decision package may be prepared at the base level. So this is what we said as a basic thing, representing the service or support, representing the minimum level of service and support needed to achieve the organization's objective. Further incremental packages may then be prepared to reflect a higher level of service. So this is the basic is what we have taken as the base level, and incremental package is the postponed, what we could postpone later. So management will then rank all the packages in order of decreasing benefits to the organization. So once we have done this, we also have to rank them. So we have to rank them as to which one we have to definitely perform. So library books can be number 1, guest faculty can be number 2, new computer can be number 3, and the painting can be number 4. So this is the ranking system. So this will help the management decide what to spend and where to spend it. This ranking or decision packages happens at numerous levels of organization. So this is what is about ZBB here. The resources are then allocated based on priority up to the spending level available. Okay, so once we have created a rank, see, usually this rank could be created by the departmental HOD, like this is how he wants to prioritize, and he could also give it to the principal for his approval. Okay, so depending upon how much the uh, allocation is going to be, it will depend upon the priority. For example, if 3 lakhs is going to be the priority, first books would be bought, then as per rank 2, like guest faculty would be like arranged for 1 lakh. The other 1 lakh is like additional level of service, so we don't want that. Okay, so second lakh will be allocated here, and we have still, uh, if the allocation is going to be just 3 lakhs, so 1 lakh is gone, 1 lakh is gone, still 1 more lakh is there. For that additional 1 lakh, computers would be bought. Okay, so this is how a 3 lakhs package or a 3 lakhs budget would be allocated. So how much ever lakhs is allocated, it could be allocated on this kind of a basis. Okay, so that's where ZBB is like very useful. So you have seen what is an ZBB. So what is the advantage and disadvantage? See, previous inefficiency and all, it's like totally it's removed. It leads to better involvement of staff because the HODs and the lower level staffs are the ones who are involving in this. So their involvement leads to higher motivation. It responds to changes in business environment. For example, if the business environment is such that guest faculty are number 1 priority, okay, the first amount will be given to this. Okay, then if computers are going to be the second priority, computers will be given 2, and books number 3 and 4. So the priority can also change in terms of the business environment, like what other colleges are doing, what does students want. So based upon what are the changes in the environment, we could also change our uh, what to say, our decision packages ranking. Understanding of the cost behavior. So how the cost behaves, we can also have a better idea. But what's the disadvantage of ZBB? See, as we have seen, this is just a small example involving one HOD and one department with just four decision packages. Okay, but what would happen if there are going to be like 10 departments? Okay, and each department is going to come up with 10 different requests. Okay, so that becomes like hundreds of decisions. Okay, see, that becomes a problem for the HODs as well as the principal. So it is going to take a long time for creating these decision packages, and it's also going to take a long time for the principal to decide what is going to be the budget amount and how he is going to allocate. Okay, so see, the first one is only approved decision packages can be undertaken without deviation. Okay, only the approved things can be done, the non-approved things cannot be done. Number two is the process itself is like very rigid in nature. It is not like much flexible. So HODs have to submit a decision package, principal will approve it. It becomes a rigid thing. Managers may not have the skill. Large amount of time spent on the budgeting process. Ranking can be difficult for different types of activities. Okay, so this ZBB involves a lot of paperwork. It involves a lot of time to do it, and ranking of all the activities is difficult. And the more and more larger the organization is, ZBB will become more and more unnecessarily complex. Okay, so that's about ZBB here. So ZBB is actually an alternative to incremental budgeting. So you can write it like this. So incremental. So incremental budget and ZBB are opposite nature. Okay, not directly opposite, like mostly they are opposite. So the advantages again of incremental and advantages of ZBB are there. Okay, so what you can do in order to write disadvantage of here, you can write the advantage of ZBB. And to write the disadvantage for ZBB, you can take it from incremental budget. So we can't like very strictly do this, but you can, in case you forget a point, few points in the examination, you can just like think like this, and you can also write some few points. Okay, so next we'll move on to something called as a rolling budget. So what is a rolling budget? See, rolling budget is very suitable for companies which are very dynamic in nature. So there are changes are happening so quickly and so fastly. So uh, even an annual budget seems to be useless for these companies. Okay, and they feel that they should have a continuous set of budgets on a regular basis. So normally what happens is a company will prepare a budget. So we'll take the year 2021. So assume that in 2021 we have like 4 quarters. We usually have 4 quarters only. Okay. So normally a budget will be prepared for each of these quarters. Okay. So for example, it can be like sales. We just create one. Sales is going to be 100 here, 102 here, 105 here, 104 here. Okay. So So normally what happens is the sales would be like would be estimated what it would be for the 4 quarters or in a particular full year. But as and when we are like nearing the end of the year, for example, quarter one is over, so this data is already over. Then when we go to quarter two, this data is done. When we end up with quarter three, this data is also gone. And when we are going to quarter number four, when we go to quarter number four, at the end of quarter four, this is also gone. So at the end of quarter four, there is no visibility. What is going to be happening for the next year? What would be the sales for the next year? How we are going to run the company next year? Nothing is available. So this doesn't seem to be like a good approach. So what happens is a company, whenever a previous quarter is over, okay, whenever one quarter of data is over, okay, what happens is immediately they also create another set of data. Okay, so this would be, so when quarter 1 of 2021 is over, they will create a quarter 2022 quarter 1 sales. So they will say that the sales would be like 105. Okay, so when quarter 2 is over, then immediately another quarter would be created. Okay, another quarter information would be created. Okay, so if you see at any point of time, there is always 4 quarter information which is always available. Okay, so there is no it's a continuous and a recurringly created budgets. So at any point of time the company does not lose its visibility, because in a normal case the company will lose its visibility when it comes to when it moves to the end of the year. Okay, for example, in quarter 4 they don't usually have any information, but in this case, when quarter 3 is over, also when quarter 4 is over, okay, immediately another set of information is opened. So even when the quarter 4 occurs, okay, even when quarter 4 of 2021 occurs, it doesn't mean that the company does not have any visibility. The company will immediately keep on having some visibility in its budget. Okay, so this is called as a rolling budget. So hope you guys got an idea. Okay, so hope you guys got an idea about what is rolling budget. So let's see its theory. A budget, usually annual, kept continuously up to date by adding another accounting period, example a month or a quarter. So what we have done here is for a quarter we have did. We can also create a monthly budget. Okay, when the earliest accounting period has expired. So when Q1 of 2021 is expired, immediately Q1 of 2022 is automatically created. So for what kind of companies is this suitable? Accurate forecasts cannot be made. Okay, so there are many industries which are so fast moving and dynamic, we cannot make an exact prediction and all. So here only like approximately we can tell what would be the information. So for dynamic companies this is like very much required, and also for businesses that require a tight control. Okay, where they cannot like lose their visibility for a year. Okay, visibility of what is going to be happening. So they always need a particular set of 1 year data ahead of them. Okay, so what is the advantages of this? Advantages is planning and controlling is like much more better. There is always a budget that extends into the future, and management creates budget which are more up to date. Okay, these are the advantages. But what is the disadvantage? There are like several disadvantages in practical, because if you see here, every quarter, okay, before every quarter ends, all the departments in the company has to create fully a set of budget. Okay, so if you take a company, the production manager, marketing manager, HR manager, okay, sales manager, advertising manager, all of them have to create a budget. Okay, they're not going to create a yearly budget, but they have to create quarterly budget every time before the end of each quarter. So at least they have to allocate some 5 days for doing this. Okay, so in a year, if you see, they would allocate every quarter 5 days. So in a year they are allocating like 20 days of their time for budgeting itself. So it is a costly thing and it is a time consuming. it also demotivates the employees because they have to spend a large amount of time. Also, the management accountant would also have a huge amount of work because they have to keep creating the master budget, cash budget for the upcoming periods, and the targets might also change. Okay, but the problem is, as this concept becomes a very uh, again and again used or repeated concept, at one point of time managers will feel, okay, why should we spend so much of time? Let's add like 2% of the last quarter, or let's add 5% of the last quarter. So at one point of time this becomes an incremental budget. The purpose of it is not an incremental budget, but it might become an incremental budget. Okay, and there is also the problem of version control. Why version control is, see, when we are trying to, when Q1 and Q2 are over, okay, we have Q3. Q3 we have estimated to be 105 of sales. But what happens is, when in a rolling budget, we might change this information from 105, it can move to 106, and this might move to 105. This might move to 104. So what happens is, whenever each quarter is added, okay, all the remaining quarter numbers are again revised. Okay, so next time when quarter 3 is going to get over, so this is over, and we are creating a quarter 3 information. When you create quarter 3 information, okay, like 107, when you create that, you also have to revise like what happens in terms of the other quarters. Okay, so we are with better data and an idea now. So we'll see that 105 is too much. We can say it is going to be 102. Okay, 105 and 106 or 107. Okay, so can you see here, we have changed the Q4 data 3 times. One was the original, okay, second time when we added this data, and third time for this data. So every time you add a quarter, this information keeps changing. Okay, that means any target that you set will keep on changing. So that is why the problem of version control comes up. Okay, because one manager will think it is version number 1 sales, another version number 2 sales, another version number 3 sales. So the problem here becomes that as all numbers are revised each time, okay, it becomes a problem. Okay, it becomes a problem of confusion here. So that's about a rolling budget. The last one is called as budget management style. Okay, so each company has its own kind of a style in which they manage the budget for the company. So there are like three budget management styles. Okay, so one is called as budget constraint, profit conscious, and non-accounting. So we'll see like what they are. So first one is manager evaluated on ability to achieve budget in the short term. So in this kind of term companies, in a budget constrained kind of companies, the focus is always on the how the manager has achieved the budget. Okay, whether he has achieved the sales or whether he has achieved the cost, that is how he is like evaluated. Manager will be criticized for poor results. So if that, what is poor results is, if he is unable to achieve the target, he becomes a very inefficient manager. So there is always a pressure to achieve the target. The thinking process of the company is always in short term, and they don't think much about the long term consequences. What happens is, each manager will try to achieve his profit targets, his cost targets. So they will become very aggressive in protecting their work. Okay, and they are very aggressive in terms of achieving their targets. So they will become they will have poor relationship with the colleagues of other departments. Okay, if the cost cannot be lowered or if the sales cannot be higher, that might lead to manipulation of the data itself. So that can be a problem. So the next one is called as a profit conscious style. So here in this kind of companies, what happens is managers are evaluated on the ability to reduce cost and increase profit in the long term. So the company does not care much about the what happens in the short term, but they care a lot what happens in the long term. So this kind of a company will encourage the managers to put more amount of employee training, better R&D, or better marketing. Okay, they will focus on those things. For example, a manager will be prepared to exceed the budgetary limit in the short term if this will result in an increase in long term profit. Okay, so a manager can go beyond the cost which is given. A manager can sell units a little bit lower, provided he could justify that he can improve the profitability in the long term. So here the job pressure is like less, and he has a better working relationship with the colleagues because he doesn't need to fight for achieving the targets. And the as the environment is little bit free, it leads to less manipulation of data. And the last one is non-accounting style. So managers evaluated mainly on non-accounting performance indicators such as quality and customer satisfaction. So who is a good manager? It is production manager will be assessed not on the cost per unit but on the quality of the product. And a sales manager will be judged on the customer satisfaction that he provides to the customers. Okay, so in non-accounting style, even profit or cost does not play a much a role. Okay, so similar to profit conscious style, but there is less concern for accounting information. So both these styles are very similar, but here no accounting information is used. Requires significant and stringent monitoring of performance against budget. Okay, so here the uh, even though there is no cost data that is used for controlling people or sales data is used for controlling people, still there are some alternative mechanisms to control the employees, for example quality, customer satisfaction, like that. Okay, so that's about the budget management style. So we could see what how these budget management styles appear in a company. So the last part of our theory is budgeting. So what are the drawbacks of budgeting? See, some people argue that budgeting itself is just a waste of time. Okay, and this is called as BB, which means beyond budgeting. So you can Google this and try to find it out. It's called as beyond budgeting. So beyond budgeting is useful where people feel that budgets are a major drawback. Okay, so what are the drawbacks of budget? One, budgets are inflexible, so once set it has to be achieved. Budgets creation itself is time consuming and it is very costly to put together. Budgets constrain responsiveness and flexibility and are often a barrier to change. Okay, so people who are very creative, people who are very achievement oriented, they feel that budgets are limiting their talent. Budgets are rarely strategically focused and are often contradictory. Okay, so budgets are not focused on strategy; they are mostly like operational only. So we have to achieve this much of units, we have to sell this much of units, we have to produce at this cost. It's very operational in nature, not very strategic in nature, and it adds little value. Okay, so for the time it is being spent to create, budgets actually add a little value rather than it only focuses on whether people are achieving that line of budget or not. The focus here is on the cost reduction and not on the value creation. Strengthen vertical command and control. Okay, so mostly it is useful for a uh, imposed budgeting or a top down budgeting. So that is how budgets are usually be prepared, not in terms of participatory budgeting or ZBB or incremental. Do not reflect the emerging network structures that organizations are adopting. See, the budgetings that we saw, okay, might not be applicable to a company like Amazon or a Ola or a Uber or a Swiggy or Zomato. So these companies are quite different in structure and nature, and a traditional budgeting might not suit this kind of companies. So encourages gaming. So managers will try to manipulate the numbers. Okay, so managers will try to find out what are the other ways, okay, to achieve the budget other than hard work. Okay, so that becomes a problem here. Are developed and updated too infrequently, usually annually. Okay, so budgets are only updated once in a year, so that's why we have the increment, the rolling budget in here. Okay, so rolling budgets are usually useful so that the information is updated every month or every quarter. Are based on unsupported assumptions and guessworks. So budgets are depending upon the future, how things will be. Okay, so it is partly a guesswork also. Reinforce departmental barriers rather than encourage sharing knowledge. So each department manager wants to achieve his goal, so he might not have a friendly approach with other managers. And lastly, it makes feel people undervalued. The company focuses more on achieving the budget rather than making the people feel better. So this is about the budget. We could apply these concepts in the upcoming cases. So then we can see like how these kinds of stuff work in a reality kind of a company here. Okay, so we can start applying them. So this case was asked in the year 2015 December, and this topic is about budget analysis. So we have a case here. The requirement of the case is required. It is clear that the business controller and the sales manager have different opinions about the current performance of the company. Analyze the data shown in table 1, suggesting possible reasons why performance may not be as positive as that portrayed by sales manager. So they're asking, so there is a difference of opinion between the business controller and sales manager in terms of the performance of the company, and you have to tell why the sales manager is so optimistic. Okay, and why the reasons that he gives might also be wrong. So we'll read the case. So we can the question has two parts. The one is difference of opinion between business controller and sales manager. Okay, so this is the first part of the question. Okay, that's just one question. Okay, suggesting possible reasons. Okay, suggesting possible reasons. Okay, we can put reasons then. Reasons for difference of opinion. I think that would be a correct thing. So as it's a 15-mark question, we have to get at least 15 points. Okay, so what is a point? A point is 2 to 3 sentences. So we can put it like this. It's a 15-mark question. We have to get 15 points for it, and each point should have 2 to 3 sentences per point. Okay, so let's try to get 15 points here. So you can read along the cursor. So this paragraph indicates us that this company is an outsourcing manufacturer, and they manufacture goods for other companies, and finally they also put the other companies brand logos on the products, and they sell it directly to the companies itself. Okay, so and also they produce hundreds of products, and which are like similar to each other. Okay, they are very similar in specification with each other, and with slight differences due to the requirement of each customer. Okay, see, the problem when you have like hundreds of products where there is slight differentiation with each product, uh, the cost of customization, the cost of setups, okay, the production runs, okay, or the number of units produced in each batch, this might become a huge kind of a problem, because these might increase the cost of production. Okay, so you have to have an idea about this. So large variety of products produced leads to higher cost per unit. Okay, this is a key point. We'll use these points whenever it is required. So we'll go to the second paragraph. Okay, so we can also get an idea that this is a B2B company. So business to business is what they sell. They do not sell to retail clients. It's not a B2C company. And the competition, so competition is becoming intense, and that will lead to lower profits. Okay, so that's what we get from this paragraph. We'll move on to the next paragraph. Okay, so customers are asking for lower price, better quality, and more innovation. Okay, so they want all things which are good, but all of this will lead to lower profit. So that is what is being said here. We'll move on to the next paragraph. So the sales manager says that he has done a really good job, but the business controller says that it is not such a great improvement for the company. Okay, so why are these two people differing? That is what we have to explain. So we can read here. So this is what the business controller is saying. We are unable to grow our profits. So you can see here, this is the budgeted data. This is the actual data. So sales volume budgeted was planned was 2,43,000. Actually sold was 2,70,000. And these are the relevant numbers here: sales, material, labor, fixed cost, and operating profit. Let's look at the operating profit, or all the numbers. So sales, you can see it's almost same. Material cost has been increased, labor cost has gone up, fixed cost have gone up, and the profit seems to be going down. So the sales manager, what he says is, I have achieved the sales. Okay, so even in difficult circumstances, we have achieved the sales of 2,70,000 units. Okay, and he has also achieved the amount of sales, but the problem is the sales amount, sorry, the profitability amount is the lower one. Okay, so why is he wrong? So we can put it like this. Number one, the number of units sold has increased, but but the sales value is same. Sales value is same. Why is it so? See, because the sales manager has given discount. How much of discount has he given? We can easily find out that. I think to do that, we need to do flexible budgeting. So that is the problem here. So once we do flexible budgeting, we'll get an idea of how to work it out. So first we'll do flexible budget. So we need two sets of data here. One is sales, but in sales we don't need, I think we need both. Okay, we need budget and as well as the actual and the flex, and finally the variance and the reason. Okay, we need all these things. So let's start. So putting in the numbers is the main thing. Sales, direct materials, direct labor, fixed overhead, and the profit. So let's get the actual. So how this flexible works is, so flexible we have to get the units. Okay, we have to get the units, then only flexible budgeting can be done. So if you see units, what they thought they will sell was 2,43,000 units. What they sold was 2,73,070,000 units. Flexible should be in terms of actual numbers. Okay, so how do we compute each of this? Okay, I think we'll do the variance part and all later. We'll first do the calculation part. The calculation part will be like this. The budgeted amount, this number, okay, budgeted amount divided by 2,43,000 units. So this will give you the budgeted selling price per unit into actual units. Actual unit is 2,70,000. So we have to do this part. Okay, so rather than putting it as this, we'll take the sales value. Sales value is 36,450. So first we'll calculate it. Okay, this is how it is computed. So what should have been the sale? What should have been the sale is the sales value. Okay, for 2,70,000 units should have been 40,500. Okay, it should have not been 36,450. Okay, the same logic applies almost to all the other numbers. Okay, so all numbers we have to change. So this would be 15,795. So when we do this, we find out what is the budgeted cost per material divided by actual units. Okay, the next one would be 3402, and next one would be 8250. So we'll first make the table look good. So let's get the difference. The difference is, I think units wise, we don't need much of a difference. Okay, we'll start from sales. See, he should have sold for this amount, but how much he sold? He has sold for this amount. Okay, so is it a good thing? Actually, it's a bad thing. Even though he has increased it, the sales remain the same. Okay, he has given a discount which has led to a variance. Okay, which has led to a variance. Okay, and for this it would be, he should have uh, the cost should have been 18,630, but the cost has been 17,550. So this is a cost here. So just take all the numbers and we'll put. So you can find out here that the sorry, the cost should have been this, and they have incurred a cost of this much. So what's the total variance? See, this is what the total variance is. Okay, the difference between what should have been, which is the flexible budget, and what is the actual, that is the actual budget. So the difference between these two is the total variance. Okay, now we can tell what might be the reason. See, the reason for this, the sales manager has a discount. So the sales manager has given a discount. How much of discount he has given? He has given a 10% discount. How do we know it? For 40,500, he has given a discount of 10%. So that has led to 4050 being the amount. Okay, so the sales manager has given discount of 10%. Okay, and if you see, the direct material cost, okay, has gone up. We don't know what's the reason. Labor cost has gone up, as well as fixed overhead cost have also gone up. Okay, so let's see what else information we have. So then only we can find out what happens. So we can start from here. You can read. Okay, so here she says that we have to move to ABC to understand who are like our profitable customers and who are not our profitable customers. But this data is not useful here. Okay, it's, I think, for ABC analysis they are telling. Let's see about the next two paragraphs. See what the sales manager has done is, sales manager has given discount. That's one. The second is he has brought in special orders with short lead times. Okay, so when you bring special orders with short lead times, okay, what would happen is this will increase the emergency purchase of materials, and this will lead to more cost. So that can be one of the reasons why it has been like that. And when we bring again special orders, what would happen is special orders increase the time to produce the product, because it might be a new product or a special product. So the employees will take a little bit more time to learn about that product, how it is being produced. So it increases the time to produce the special products. Okay, special products. So this will lead to more cost. So he also says that okay, so this seems to be the problem. So why is like fixed overheads is going down? See, we don't have much of a reason for why fixed costs goes up. Okay, uh, fixed cost in I think in terms of production only they are mentioning, but there's no reason for why it goes up. Okay, but we have got some reasons. Okay, so let's get the answer here. So the reasons for the difference in profit, okay, one, the company produces a large amount of products. This leads to a high profitability, high cost. B2B, I think B2B, okay, this B2B leads to more, okay, more or leads to lower profit per unit. Okay, because B2B usually leads to that. Only when you sell it to retailers, you can charge a higher margin, and that's a problem. That can be a second point. Intense competition will lead to the third one. Customers are asking for more of these things. That can be the fourth point. But all of these are general points only. Okay, they are not maximum related to this concept. But without understanding these points, we cannot explain the other lower points. Okay, so marks will also be given for the calculation. Okay, for the calculation of this, they will give you marks. Okay, and also for the explanation of these variances, they will also give you some marks. Okay, so 10 marks you can easily score here. So that's about the answer here. We cannot write anything more than this, because that is what the case has given us information. Maximum, if you want to write, okay, you can say that ABC, activity based costing, will lead to proper identification of cost driver. So that can be one point. So I think you can also, I think for profit difference also, you can, they will give you 1 mark. And the 13th point, we can also say, okay, the company should use ABC to differentiate between profitable and unprofitable customers. Okay, ABC will help you to do that. So maximum we could write similar points like this. Okay, but we can't extend the points too much of it. Okay, then we'll go much beyond the the points. Okay, from the case itself, we would at one point of time move on, but we'll write very general points. So that's about this problem. Hope you got an idea about how to crack the information. The information is cracked based upon the table here. Okay, so if you don't know what is flexible budgeting, you cannot score any marks here. That becomes a problem, because you could argue all the theoretical points, but without doing flexible budget, we can't get any marks here. So ensure that you understand the concept behind this. We'll move on to the next case. So we'll start from here. So this question has 3 requirements. So I think we'll first start from here. This question was asked in June 2015. Okay, the topic is zero-based budgeting, and these are the requirements for it. So we'll start from the requirements. Describe the main steps involved in preparing a zero-based budget. Discuss the problems which the listing regional authority may encounter if it decides to introduce and use budget ZBB to prepare its budget for the coming years. Okay, so implementation problems with ZBB. Okay, so that's what he's asking, implementation problems. Then outline 3 potential benefits of introducing ZBB. Okay, so benefits of ZBB for the so here it is 9 marks. And here it is 3 marks. So we have to get 9 points for this and 3 points for this. So that's what is our concept. So we'll read the case and we'll see how this case works.